Hello, and thank you for joining us. Welcome to Marcus & Millichap's National Apartment Market Update. My name is John Seabury, and I am the National Director of Multifamily for Marcus & Millichap. I'm joined today by Hassam Naji, a Managing Director of Marcus & Millichap, and Bill Hughes, the Managing Director of MMCC Capital Corp. Our job today is to provide you with an update on the broader economy, apartment market supply and demand, trends in the capital markets, and factors influencing apartment investment. You will see on your screen you have the option of submitting questions to us throughout the presentation. We will monitor your questions as they come in, and the three of us will be addressing as many as time allows. If at any time during the presentation your screen or sound freezes, use the F5 key to unfreeze. You will also have the option on your screen to download the slides that are provided as part of this program. To begin, I would like to turn it over to Hassam Naji to provide an update on our economy and apartment supply and demand. Hassam?
Thanks, John. Good morning and good afternoon, everybody. It's a pleasure to be part of this program again, and thank you for joining us. My job today is to talk about what's happening with the economy and where we're headed in terms of our economic drivers. The most important thing is that the sequester has now taken effect, and we've had tax increases at the beginning of the year. Given the combination of the sequester and tax increases, there is now a new drag on the economy. There's a lot of concern about whether these two new issues are going to derail the recovery. And our conclusion, having analyzed this quite a bit, is that it will not derail the recovery, but it will rob from the rate of growth. What would have been a probably 3 to 3.5% growth rate for the U.S. economy is not going to stay in the 2 to 2.5% range. So the improvement that we would have experienced over 2012 and 2011 and the improvement over the drag that we've experienced has basically been erased because of these two factors. That's the bad news. The good news is that the economy continues to show incredible resilience. And the numbers, although not exciting and not above trend line by any stretch of the imagination, are strong enough to continue the recovery in commercial real estate in general and apartments in particular. In sharing with you some of the most important drivers of this conclusion, we always start with retail sales because 70% of our economic output is connected to consumption in the U.S. And you've seen this chart before if you've joined us in previous presentations and discussions, and you can see that on the left we show the unprecedented nosedive of retail sales in the U.S. during the last recession. The blue lines are recessionary periods and the recovery since. But on the right, more importantly, we show the nominal, the actual retail expenditures per month. And the point of this graph being that we are now 12% above the prior peak in retail sales in the United States. If you account for population growth and so on, even on a per capita basis, we're now 6% above the prior peak. This is a very important statement in that it reflects a very strong footing for the U.S. economy. In the last 12 months alone, retail sales grew at about 4.5%, and that kind of a growth rate is indicative of an economy that's expanding, albeit at a pretty moderate pace. Now, so much of the discussion regarding job growth is on the negative and the disappointment, but if you look at the last 12 months, as an update, again, if you've joined us before, you've seen this analysis. It's a very important way of looking at the economy because besides the nearly 2.2 million private sector jobs that have been added in the last 12 months, the statement this graph makes is the broad nature of these job gains. You can see every major sector of the economy adding meaningful numbers of jobs. Professional and business services topping the chart at a little bit under 600,000 jobs. Trade, transportation, utilities at 400,000 jobs, and that speaks of the strength we're seeing in both the office and industrial market coming back, and of course the generation of jobs for the young adults that tend to rent apartments. Education and healthcare, construction is now beginning to come back, and even manufacturing has added about 70,000 jobs. So if you look at the corporate part of the ledger, we talked about the consumer part of the ledger. Besides the job growth, you can see some other indicators like the fact that corporate profits are now over 20% above prior peak. So corporate America is in great shape. It's cleaned its balance sheet. It's ready to grow, but still hesitant because of the logjam in Washington, because of higher taxes, because of continuing global macroeconomic concerns. Even though we haven't heard a lot regarding Europe, for example, it's still kind of out there looming. And that hesitancy is one of the continued reasons we're seeing job growth at a healthy pace, but below what it normally would be in a recovery. A lot of people, of course, are curious about job growth around the country. It's very important to detect the different trends. And what I can tell you is that the key drivers of metro-level job growth are the sectors of the economy that are outpacing. For example, trade and transportation, professional services we talked about, but also technology, energy, and anything that has to do basically with the movement of goods connected to our ports. So it's no surprise that Texas, as a state or a region, if you will, is leading the job growth. Houston at over 100,000 jobs in the last 12 months. Dallas nearly 100,000 jobs. But now you get to see some other major metros like Los Angeles join the top rank, shown here on the left of this chart. 77,000 jobs, a 2% job growth rate for Los Angeles is well above the national average and a very healthy pace for a large market like that. By contrast, you look at Chicago, which is another very large metro, 41,000 jobs and less than 1% job creation. So the pace is not reflecting a whole lot of strength in Chicago versus Los Angeles or in New York, for example, at about 60,000 jobs. Recently, Atlanta has joined the ranks of the top job creators around the country. And some other metros that have done phenomenally well include Seattle and, of course, more recently, Washington, D.C. Seattle in particular with a 2.2% job gain. Florida has been generally absent from the leading markets in this recovery. Tampa made the list this time around. And Florida still continues to lag as a state in general. I think 2014 is a very important year for that recovery to really kick in Florida because of the acute housing crisis that the state had. So on the right of this chart, you see the lagging markets, and the basic trend or common denominator here is lack of a catalyst, lack of a driver of anything that would generate huge numbers of jobs, although all these markets are now at least in the black. They're adding jobs. Taking a look at the other components of the economy as it relates to the broader macro trends as well as the rental market, we see that the recovery in the for-sale housing market has finally really stuck. We've seen head fakes in the past. This particular cycle I don't believe is a head fake because the fundamentals have really improved. We've had 5 years of household pent-up demand being held back because nobody really had confidence in buying homes or were unable to buy homes. And now all of a sudden we're beginning to see a sustainable year-over-year increase in prices to the tune of 10 to 12% and existing home sales increasing by 10%. This is an important factor for the economy because of the fact that if you look at all prior recessions and recoveries going back to the 1950s, by this point of a recovery, the for-sale housing market would have contributed nearly 40% to our economic output. In this particular cycle, it's only contributed about 16% to our economic output. And as for-sale housing becomes more of a driver, we're actually going to benefit from a new driver to the broader economy because it'll trickle through construction jobs, furniture sales, and all the ripple effect that for-sale housing has for the U.S. economy. You can see on this graph that we took a much, much bigger hit on the way down because of housing, given the nature of the financial crisis that we had, and a much more muted contribution to the recovery. So it was really the combination, two very bad combinations that are now beginning to turn in favor of the economy. So a lot of our apartment clients around the country are concerned about home buying and loss of renters to home buying. We saw a tremendous amount of loss of renters in 2003 to 2005 as there was so much speculation in home buying, and it was not really a fundamentals-driven environment. It was a speculative environment. So this time around, if you look at the most recent trends, when there was a lot of incentives for people to buy homes, the tax incentives and so on to get the recovery going, you saw a lot of first-time buyers actually take advantage of that, and the percentage of first-time home buyers was ranging in the 40 to 60% range in various quarters of 2009 and parts of 2010. We have now settled to around 30%, and that number seems to be very steady. So what I was looking for here was to see if in the last few quarters there have been any spikes or any kind of a turn in massive numbers of renters now becoming homeowners, and we're not seeing that. That is not to say that a lot of our apartment clients around the country, particularly the larger Class A clients of ours, are not experiencing loss of renters to home buying. It is happening. However, it is not happening at a scale that concerns us about the demand side of the equation being derailed or being substantially reduced. In fact, if you look at what's happened with apartment net absorption over the past 2 or 3 years, on the red line of the graph in front of you, you see the tremendous spike that we had in renter demand coming out of the recession, given what was happening with the falling home ownership rate, given what was happening regarding the uncertainty of home buying for any would-be home buyers or their inability to qualify for loans. And we can see that settling down now to a more sustainable, more of a correlation between job growth and the more classic ways that we expect to see net absorption behave along with economic drivers. Although there was a lot going on besides just the job growth that basically created the spike that you see because of the unfavorable views people had regarding home buying. Now we're beginning to see more of a equilibrium, more of a sustainable, lower but still steady level of demand on a quarterly basis, with renters showing up pretty strong in 2013 so far. Although the numbers of units absorbed compared to 2012 are declining moderately. So what's happening with the broader supply-demand picture? You can see that construction, having gone down significantly during the crisis, the financial crisis, has now begun to come back. We're seeing about 140,000 units on their way of being completed and delivered this year. That's the highest really since the crisis began and leading up to the crisis. And a lot of our clients are becoming concerned about these levels of new construction. Well, before we really dissect that, take a look at the vacancy trend. We're pretty much back to or very close to pre-recession metrics. We're at about 5% vacancy across the industry. Many markets, of course, below that, and we'll talk about that in a moment. But when you've seen this kind of a rapid recovery in vacancies, we've seen healthy rent growth for the past 2.5 years. The kind of construction numbers that we're now beginning to see are pretty much in balance with the demand that continues to occur in the marketplace. If this number were to increase substantially back to the 200,000, 250,000, at some points 300,000 units, then I would become more concerned. But because of still tight lending, because of the fact that a lot of the construction has been urban development and infill focused, which are a lot more expensive to deliver, we believe there is natural breaks, especially with equity becoming more cautious and more concerned about the next round of development projects. And these natural barriers, we expect, will keep the construction part of the equation in check. If you look at the metro rankings around the country, you see the lowest vacancy markets on the left. New York was accidentally omitted from this chart. It really belongs there with less than 3% vacancies. But you can see some very interesting trends with, for example, Minneapolis and Miami now around 3% vacancy rate. We have plenty of other markets that are extremely tight, like San Jose, for example, Portland, San Diego, a lot of the usual suspects. But Seattle now continues to show improvement and is down to vacancy levels that qualify it for the tightest markets. We'll talk about construction at the metro level here in a moment. On the right, you see some of the highest vacancy markets. And it's interesting, if you look at the marketplace as a whole, this chart really reflects the kind of options that investors have. You have the supply constrained, a lot of the coastal markets, low vacancy, high barrier to entry markets on the left, and you have a recovery story in some of the more volatile markets like a Las Vegas, like an Atlanta, like a Phoenix, like a Dallas, that now qualify for having improved quite a bit, yet still show high vacancy rates, comparatively speaking. But a 6.4% vacancy rate, for example, for Dallas, historically, for its own long-term history, is a very healthy rate. Atlanta at 8.5% or Vegas at 8.5%, both still have a ways to go to come down to the 6.5% or 7%. But these recovery markets are now offering an interesting investment choice. And this is what I mean by the dichotomy in the marketplace that really translates to the safety and low yield kind of an environment, and then the recovery options that some of these markets are offering. I think it becomes more and more important now to track the construction cycle at the metro level. And we're seeing some numbers that are somewhat concerning. For example, in Dallas this year, we're expecting over 12,000 units to be completed. Washington, D.C., which has had its ups and downs, expects 11,000 units. And when you're delivering those kinds of volumes and look at the percentage of base, total multifamily unit base that's increasing, that becomes a little bit of a concern. Now, Dallas, I showed you earlier, was among the job-creating leaders. So in the short term, we're not anticipating any major problems. But D.C., on the other hand, did not have the kind of strength in job creation that, for example, Texas is showing right now. So I think it becomes very important to drill down on what is happening with the pipeline of both proposed projects and projects that have been approved. What's interesting, too, is the fact that you now see markets like Austin with 8,000 units or 4.5% of their base now entering yet another potentially volatile cycle, as Austin has done frequently. Seattle with 7,500 units is another one that is somewhat concerning. Again, the job numbers there may offset that. But going forward, we really want to monitor what the distribution of new product by metro. On the right, you see the markets that really have no reason to be adding any new supply anytime soon, and they are not. So the markets on the right are ways off from seeing any meaningful construction. I'll close the section by talking about our biggest concern. The cycle is getting mature. We've seen the recovery really take hold and bring the dynamics back to pre-recession levels. We're very close to it. If you look at the rental side of the equation, we're now just about 7% above prior peak in overall rents. And if you look at this particular chart, you can see that the renter household income, the income levels of those that rent, is not keeping up with the rate of effective rent growth increase. And so that becomes a bit of a concern, especially for the top-end Class A units. Although those are in great markets, very competitive submarkets for the most part, that draw a tenant base that is really a renter by choice, monitoring the relationship between rent growth and household growth and the tenant's ability to keep up with the rent increases becomes much, much more important at this point of the cycle going forward. The last 2 or 3 years, we're kind of catching up, but the next 2 or 3 years, we have to be very careful about not overshooting the expectation of rent growth. So at this point, to make the presentation and the discussion more interactive, we wanted to ask you your opinion about what you expect in terms of rent growth. So in front of you should be a question, a very simple question about the next 12 months and your expectations on rent growth. Will it increase by 3 to 4%, or maybe as much as 4 to 6% in your opinion? This is a broad question, not a particular market. Remain flat or decline?
Great presentation as always. I guess I've got to ask you, and I think the audience is going to want to know, are we nearing the end of the cycle of rental demand? You talked a little bit about your concern about that, but where are we? Where do you see it next 6 months, 12 months?
Sure. I think we've gone from this unusually high levels of renter demand, way above norm, way above the usual metrics of job creation to renter demand and so on, to have settled into a steady, strong, but not quite as exceptional levels of demand going forward. Remember, we still have 3 million more young adults that moved in with family or entered the 18 to 34-year-old age group demographically over the past 4 or 5 years that are living with family. So 3 million young adults at some point, I'm sure many parents are wishing for this to happen sooner than later.
I've got a few.
You are one. Are going to move out and rent their own units. That's a tremendous amount of pent-up demand that's in place. We're going to lose some of that to home ownership. We're going to lose some of that to renting single-family homes. They're not all going to rent professionally managed apartments, but that's a very strong underpinning demographically. Even with home buying coming back, we're still looking at a lot of consumers that still would prefer to rent. They want the flexibility to rent. Young people want to chase jobs or be flexible when moving around the country. And then just looking at our demographics, the echo boomers over the next 5 years are just coming into that peak renter time frame. So I'm not worried at all. I just think we got used to this exceptionally above trendline levels of demand. And when it settles to a normal level of demand, it feels a little bit scary.
Right.
Right.
John, any thoughts on your part?
Yeah, I did. I have a question. I know that we've talked a lot about rent growth and we've talked a lot about employment growth, but then there's also wage growth within that.
Right.
And how much is that affecting the ability of a lot of these apartments to continue to raise rents? Because I know we've had a lot of markets that have had excessive rent growth, and we've even asked the poll question that plays to that. At some point, does that start to affect how much we can continue to push rents in some of these markets?
Absolutely. I think you've got the renter by choice that's not as hindered at all. They prefer to rent the gorgeous new urban infill types of product with great amenities, and they have the jobs to support it. Then you have the next tier of still Class A product, and that's where I think we're most vulnerable in that, as the rents go up, the alternative to buy a home and so on becomes more vital. And if anything, the Class B and C rent growth, because it's lagged so far, I believe is going to be more robust in the next 12 to 18 months than the A rents, because the A rents really led the recovery. But yeah, ultimately, if the tenants can't afford the rent, they're going to double up or they're going to do something. Now, I'm being told that the poll results are in. If we can show the results, it'd be interesting to see what our audience believes will happen. So 64% believe it's going to increase in the 3 to 4% range. So it's more continuation of what we've seen. I was curious to see if we have a lot of optimists in the audience breaking into that 4 to 6% range, but it looks like the 3-4% is still what the industry expects.
Okay. Hassam, thank you very much for the presentation. Bill, capital markets. How do we look?
I don't think it's any secret to anyone out there that we are brokers, and there have been occasions during these presentations that the perception has been that we've been overly optimistic in our comments. Well, ladies and gentlemen, I'm not going to do much today to dispel that notion. From our standpoint, the market couldn't be much better than it is today. There's low cost of debt and equity for virtually every client, every transaction out there. In the multifamily arena in particular, there are a wide variety of capital providers available serving all asset classes in virtually every market. A assets to C assets, primary markets to smaller tertiary markets. We're finding capital available for virtually every transaction today. And while underwriting principles remain strong, they have turned also accommodative. And what I mean by that is that lenders are now considering in-place and future rents as opposed to simply trailing rents. Earn-out structures are in play today where we can forecast rents a little bit, allow some time to achieve those rents, and provide some additional debt. Along with that, debt service coverage 125 to 115. 115 for commercial banks is becoming to be the norm, with loan to values clearly in the 70 to 80% range. New construction is certainly a point of conversation. Concern over continued rent growth, concern over continued renter demand in the marketplace. There are those markets that construction lenders have already done a deal or two in. They're going to be trying to stay away from those markets, and yet there are new markets that they're moving into, and clearly they're going to push in those suburban markets. And with all that said, new construction is going to be highly scrutinized as we move forward. Equity requirements in construction loan today of 30% of cost, pretty typical. For the multifamily market itself, the capital stack is, as I said earlier, extremely well served by a wide variety of lenders, agencies certainly, life insurance companies, local regional banks, debt funds, and CMBS lenders are a big part of the market today. So looking at transactional business and who's doing what, certainly dominated by the GSEs at 61%, down from the previous 5 years, however, followed by commercial banks at 20%, life insurance companies at 7%, and CMBS lenders at 5%, which looks like it's starting to gain ground in the multifamily arena as we speak. The one challenge, and this is the one thing I can point to as maybe not being optimistic, is that the GSEs have been mandated now by Congress to reduce originations this calendar year by 10%. while at the beginning of the year, none of us really thought this was significant, this will have impact on the market over the next 3 years as the GSEs actually increased originations during the first quarter by 8% on a year-over-year basis. That means they now need to account for the first quarter increase as well as the target annual decrease over the next 3 quarters. The question becomes how. Wider spreads, more restrictive underwriting policies, lop off lower asset classes. We're not really sure yet, but clearly the agency lenders are going to have to pull back from their aggressive nature in the marketplace. The bright spot here is that certainly there are other lenders that are very capable and very interested in stepping up to carry the additional load left by a little bit of a pullback on the GSE lenders. The next time we look at this slide, we expect certainly with those comments, small reduction in GSE debt with corresponding increases in bank and CMBS outstandings. Life insurance companies will remain about constant. Their market is pretty fixed, and until we see some push out in rates, I don't think we're going to see a lot more life insurance company involvement in the multifamily arena. So let's take a look at interest rates and inflation and the relationship between interest rates and inflation and compare today's numbers with long-term averages. I'll focus your attention. There's a box should be on the lower right-hand side of your slide. It's the 10-year average. With the 10-year Treasury core inflation currently at 190, we're right at the average of inflation over the last 10 years, but we're well below the 10-year average for the Treasury. And while we don't think Treasuries will move to that 10-year average anytime soon, they will most certainly increase when the Fed stops supporting this low interest rate environment. And while the Fed has said they will continue stimulus until unemployment drops to about 6.5%, realistically, we anticipate some reduction in stimulus before that with rates moving up. The question for all of us is clearly when is that going to happen? If we know that, everybody's going to jump on the bandwagon to take down as much long-term fixed rate financing as possible, which in this environment is what everyone's been traditionally doing anyway. So it's just one more thing to watch for, and timing is going to be critical for us. I did want to talk about also, I need to jump to a slide here. Investor considerations, considerations and outlook for the marketplace. Debt and equity markets, as I've spoke to, are expected to be stable and accommodating. Risks to the marketplace are clearly interest rate. We're in an extremely low interest rate environment. And then, of course, the agency lenders pulling back from the market a little bit is sort of a short-term and maybe not a significant risk, but nevertheless a risk as it is. The nice thing about the marketplace, we're even seeing lenders move into value-add properties, and I think that that's a big push in the marketplace today. And we're seeing extremely strong rates in the value-add bridge-type product, 400+ L or LIBOR, 4.5 floor. You could do a 5 to 550 LIBOR-based deal with no floor. You can do a more dramatic value-add transaction with significant increase in income, where you're pairing off an A and a B note, and the A note being over a longer period because you've taken a longer time to fix that property. It's going to be in the 6 to 7.25 range, with your high-end portion of the leverage up to, let's say, 11.5 to 12.5%. Extremely good quality of financing to be able to do that. Certainly, construction leveling activity is something, as I spoke to before, is in play. It's being highly scrutinized in the multifamily arena. No one wants to be the last guy in the market developing that top-end apartment complex with rental demand starting to fall off, and so lenders are going to be very cautious about that. But nevertheless, we still see construction lending, particularly in suburban markets, picking up across the country. And as I said, when we move to our sources, plenty of sources. GSEs are going to continue to be active. CMBS lenders are clearly going to gain ground over the next 12 months, and we see that happening today. This point in time last year, I think the CMBS market was just around $10 billion. We're currently over $32 billion as point of fact, so it's moving nicely in the direction of being more active in the marketplace. Certainly, debt funds are active all along the capital stack, providing higher leverage financing. Life insurance companies are in play, and I think it's a good part of the marketplace. Lastly, I just want to speak to strategies for investors in the 1 to 10 million. You certainly have Fannie Mae, the small balance product, commercial banks, particularly regional and local commercial banks, a little bit larger, 10 to 20 million. You've got the GSEs, life insurance companies. Certainly commercial banks are in play, and CMBS, it's really their sweet spot. And then above 10 million, once again, GSEs, life insurance companies, commercial banks, particularly the large national and international commercial banks are in play. CMBS lenders to a certain extent, but their market is really right now defined more by the 10 to $20 million deal. And finally, debt and equity funds available all along the equity stack, the capital stack. So a wide variety of debt and equity providers available to us in the marketplace. So that's the capital markets outlook.
Great.
Tom?
Bill, we have another audience question related to interest rates. If we can launch that question. Before we get your opinion, Bill, let's see what the audience expects to see with interest rates over the next 12 months. Do you expect interest rates to be the same, go up dramatically, which is at least by 150 basis points from the below 2% or so that the 10-year Treasury is at now, go up moderately by 50 to 100 basis points, or go down? Interesting to see how our client base feels about this. So now let's ask you, Bill, given everything that we've talked about with the economy, given where we are with the Fed's incredibly accommodative approach to get this economy going, looks like the economy is doing moderately better, not off the charts, but moderately better. So 12 months from now, where do you think the 10-year Treasury will be at?
Boy, that's a bit of a look question. I'm going to give you an honest answer. I think it's going to be within 20 basis points of really where it is today, and the reason for it, this economy is still very sensitive to employment, unemployment. There's still a lot of issues out there that impact the flow of money into our treasury market, into rates. I don't see the Fed taking any real action. That's really going to be the key when the Fed starts pulling back from their bond purchases on a monthly basis. And I think clearly that will happen before they actually shut it off. So what you'll see is we'll move from an $85 billion a month purchase to perhaps a $75 billion to a $60 billion. That is going to launch these interest rates certainly moving north, and it will be in a much greater manner than the 20 basis points I'm talking about. So if that were to occur this year, if we were to see, first we'd see the Fed start talking about it. You'd pick it up in the meetings of their central banking committee meetings, where you'd have more and more of the governors starting to say, hey, we're concerned about inflation, the economy's rolling smoothly, we need to start to pull back. I think that's what happens to the marketplace. I just don't see that happening this year. I think it's going to be, and if it does, it will be in the last quarter, but I think it more realistically is going to be the first quarter. Sequestration, I think, is going to pull this economy down enough to kind of keep us on even keel for the next 12 months. I'm very optimistic, as you might tell, with interest rates today.
Well, the inflation numbers that you show certainly support the fact that we don't really have an inflation issue. It seems to me, though, at some point when the economic wheels catch more tightly and we begin to see job numbers instead of 150, 175,000 jobs a month go up to 250 or 300,000, at that point, I think then I would be a little bit more cautious and expect interest rates to begin to move up a little bit.
Clearly, we saw the Treasury just this morning drop off fairly substantially as a result of some unemployment numbers that came out, and that's the kind of reaction that we had to the market. And I think that we're going to see that choppiness based upon employment. That's a real key to whether or not the government's going to continue to stimulate the economy. Sure. Once again, their target's 6.5%.
Right.
But I think it's going to happen really long before we get there. I think they're going to start tailoring it back before we get there.
Well, let's see what the audience feels. I think the results are in. The audience generally agrees with you. Maybe that 20 basis points is closer to 50. But that's a minor difference. John, any thoughts?
Yeah, I've got a question. We're talking about where the Treasury is going to go. One of the comments you made was that the GSEs have stated that they're going to pull back on their lending some. Obviously, they're going to do that by increasing their spreads and increasing their underwriting of the deals that they're looking at. Your comment was a lot of the banks, CMBS, insurance companies will be able to fill in that gap. And obviously, multifamily is a very desirable product right now. But I'm curious, if they raise that spread, if they raise that margin, are the other lenders going to come in and offer that same low margin, or will the overall margin increase some on what investors are paying?
Well, you'd think just naturally if one of the biggest contributors to debt in the multifamily arena raises its spreads, everyone's going to follow suit on some level. You don't have to win the business by 20 basis points. You can win the business by 10 basis points and take it off the street. And bankers are very smart, and life insurance companies really need additional yield, so their yields are a little bit higher. I think the CMBS market will take advantage of that as well. I think first though they'll try to gain market share, and I really see the CMBS guys wanting to take some market share back. You know, back in 2006, 2007, they were significant in the market, and then they went down to zero in 2009, 2010. And so now they're back. They're going to try to do that. I think the other thing that is happening, commercial banks, from international to national to regional to local banks, are very active in the multifamily arena, and they're pushing to get as much product as they can. So it's not that we're not going to have enough capital. You might question whether or not the cost is the same and that the lenders will be able to push some spreads out, and clearly that might be the case.
One last observation. If you look at, now that I can actually see the graphic, 42% of our audience is expecting something worse than 50 to 100 basis points. So I think there's clearly fear in the marketplace about higher interest rates, which speaks to the importance of these low interest rates as a segue to your section, John, on the investment front.
Right.
So
very good point. Thank you very much. Thank you. As we look at apartment investment and the outlook, let's take a look at the amount of capital that has flowed into multifamily. Continued improvement in fundamentals combined with low interest rates has fueled a dramatic increase in multifamily investment overall. Average annual sales volume in 05, 06, and 07 was about $119 billion, and then it dropped to as low as $23 billion in 2009. So just 20% of the previous average. Total sales volume in 2012 increased to $86 billion. And we expect 2013 will be above $95 billion. An interesting trend is the percentage increase in transaction volume for the $1 to $10 million and the $10 to $20 million price tranche has outpaced the percentage increase in the $20+ million product. The volume of institutional sales, which led the recovery, have begun to level off, but private investor-dominated sales are showing increased volume and price appreciation. My expectation is this trend will continue. When we review the average price of multifamily product over the past 10 years, you can see the values peaked in 2006. Then, as our economy dropped into the recession, values hit a low point in 2009. During this time, the cap rate trend was moving conversely to values as expected. But an interesting point is that values are back to a number comparable with 2006. Improving market conditions and a recovering economy should continue this trend line. This slide shows pricing trends over the past 12 years broken down by price tranche. The red line denotes properties valued in excess of $20 million. Notice the sharp drop in this red line, starting in 2007 as liquidity dried up and the recession gripped our economy. The higher valued properties are more closely tied to institutional equity, and this owner profile was very quick to retreat. Then, notice how quickly the red line increases. So just as institutional equity was the first to jump out of the market, they were the first to re-enter. Today, that price tranche is back to 2007 high mark, and in many markets, prices have exceeded the 2007 numbers. Values in the $20+ million range have leveled off during the past 24 months, while values in the 1 to 10 and the 10 to $20 million range have continued to increase. This analysis shows the historical cap rate spreads between Class A and Class B and C, but includes a separate line for Class A preferred markets. So this will include institutional-grade assets located in one of the 9 most desired cities. Note the delta in cap rates between the 3 lines in 2003 and 2004. In 2005, 6, and 7, the best quality assets remained stable, but B and C quality assets experienced a rise in cap rates due to the competition created by single-family home market and subprime lending. Post-recession, this delta in cap rates is over 300 basis points. Class B and C cap rates have not come down nearly as fast as Class A due to the risk factor, but we expect this gap to narrow as more investors pursue Class B and C properties in search of higher yields. A cap rate trend comparison by primary, secondary, and tertiary markets. Each market type shows a similar trend line over the past 8 years, but notice how quickly cap rates dropped in primary markets in 2010 and 2011. This corresponds with the increase in values of our $20+ million properties. What I want to make note of is the opportunity for further cap rate compression. In 2006, 2007, and 2008, there were limited unknowns in the real estate market and the overall economy as well. We at that time, we all kind of thought things were going well. As a result, the delta in those cap rates in between primary, secondary, tertiary markets was reduced to about 100 basis points. Once the recession began and economic uncertainty influenced the investment markets, this delta increased over 300 basis points. Today, the recession has passed, and we are in a sustainable economic recovery. As this recovery proceeds and investors continue to chase yields, this delta in cap rates between different markets will diminish. This doesn't mean cap rates in primary markets won't increase. They could. But if they do, I think cap rate trends in secondary and tertiary markets will mostly run parallel, and this delta continues to compress. Long-term average for the delta between the 10-year Treasury and cap rates is about 300 basis points. Today, that margin is over 400 basis points. Furthermore, most investors are purchasing multifamily because of the belief rents will increase substantially over a 7 to 10-year hold period. With a locked interest rate, the further rent growth will generate sufficient long-term IRRs. That's a big part of what's really driving our investment real estate market right now, is that gap between cap rates and the 10-year Treasury.
Great. We have another audience question as it relates to investment strategies. If we can launch that question, that has to do with the audience expectation for apartment values and what everyone is expecting to see over the next 12 months. John, let me ask you, already we have had a lot of audience response coming in with a common denominator. Is there a bubble in apartment pricing? Given the low interest rates, given the tremendous run-up you showed in dollar volume, a lot of people are becoming more and more concerned about valuations just getting out of hand. What are your thoughts?
I don't think there's a bubble. I'm very, very optimistic over long term. Now, I don't think we're going to have the increase over the next 5 years that maybe what we've had over the last 2 or 3 years. I think there has been a correction, and so there has been a dramatic increase in rents. There has been a dramatic increase in values as occupancy rates have increased as well. But if you take a step back and you look at the amount of new construction that's taking place, both single family and multifamily, you look at our occupancy rates right now, you look at the fact that our job growth is still not gaining on where we are in the economy. We're treading water, we're gaining just a little bit, but we really have not had a sustainable job growth-based recovery in our economy. I am not concerned about a bubble.
Bill, any thoughts on that?
Well, I'm concerned about a bubble in that if the marketplace just changes overnight. I mean, if you see interest rates jump up overnight and things happen overnight, but I'm not overly concerned about a bubble at this point in time. I just, call me pessimistic, if you will. But I'm not. I think this economy is just too darn choppy. I just don't think it's going to be that it's going to come around that quick, and I don't think it's going to give the Fed the fuel to do what they need to do to start pulling stimulus back from the economy and stop their bond purchases programs and keep, let longer term rates go up. I think that we're too, from government, the benefit of what it means in government deficit, finance government deficit, what it means to the residential sector in keeping the residential sector moving, what it means to the commercial sector. I just don't think the Fed has the heart to pull that from the marketplace right now.
Sure. Well, the other I think part of the discussion has to do with applying the bubble concern to the different tranches of the marketplace. Certainly at a 3.5% cap rate or a 4% cap rate, right, where a lot of the very high quality transactions are trading at, you would ask the question, given the fact that occupancies have recovered to pre-recession levels, we've already regained and then exceeded rent levels at an average, as I mentioned earlier in the presentation. So you don't have as much improvement going forward as you've had looking backward. But if, in my mind, as I work with our more institutional clients or larger private investors who are looking at those kinds of transactions, they're typically in very high-quality submarkets, near job nodes. They have a renter by choice draw, they seem to. And they're not near a lot of available land that could go up in terms of hundreds of units anytime soon. So when you then take a look at the interest rate equation and look at the fact that you can lock in, especially these larger investors have low leverage, locked in at current rates with the conditions and the fundamentals, looking ahead, it does seem to kind of alleviate the concern of a bubble.
I would agree. Let me throw this out because right, it's another part of the equation. We're talking about low cap rates. We haven't really addressed the high cost per unit. In some of these markets, the cost per unit seems to be excessive to me. So to what extent does that impact the investor's attitude towards moving forward with a deal? And then how does that play with replacement costs, which is what you're starting to touch on?
It's interesting. Replacement cost is pushing the equation toward development, but development is so expensive because it's dominated by urban infill, and the equity participants are becoming more and more cautious about that. So that natural break, I think, is actually a good thing for the macro trend. And I agree with you 100%. I think development is going to push more towards suburban areas because the urban development is getting so difficult.
I totally agree. And the urban development is getting more expensive, not only on land cost, but on supply cost, correct, on labor cost, on the cost of getting land entitled. All of those things are adding up, and I think what we will see is more developers start pushing back out into the secondary or the suburban markets on a lot of their new construction.
Right. Another important question that's come in from a number of participants on the session has to do with interest rates and cap rates in the future. So if we eventually see interest rates go up, let's say from the current 2% on the 10-year Treasury to a normalized 3.5% or 4%, which at some point will probably happen over the next few years. What does that do to cap rates, and is there a one-for-one correlation? John, you want to start with?
No, I don't think there's a one-for-one correlation because I think if we go back and we look at that graph, what we notice is that, and what we continue to talk about, is the fact that the spread today is, depending on, the Treasury, is 410 to 430 basis points between the 10-year and our average cap rate. So the question is, as that 10-year starts to rise, do the cap rates also start to rise? I think that compresses. I think what happens is that with our economy right now and the fact that we're at the very early stages of a long-term positive growth trend, that people will start accepting a little bit less returns on those deals moving forward.
Plus, remember, rents, even at a lower pace, are going to continue to go up. I mean, if the economy is doing well.
Absolutely.
And I agree with that, but my concern with that is at some point in time, the economy starts to straighten out. Employment continues to improve. We hit that 6.5% rate. the marketplace stabilizes, rates aren't going to just move 50 basis points. Right. We could see a rate movement of clearly a couple hundred basis points in a relatively short period of time. The Fed stops stimulus, stops buying long-term bonds, which will naturally start pushing long-term bonds up. The economy starts moving. We get a little bit of inflation. The Fed's going to have to take the opposite side of the story here to fight inflation. Yep. And we could see that move back to more of a normalized market. When I say normalized market, we were talking about the 10-year average of the Treasury being at 360. The 20-year average is considerably higher. It's over, I think, 5.5%. So, sure. We could see Treasuries and rates then move up back into the 7.5% range.
So much for your optimism. I think I don't disagree with that. One thing that we have to realize is as that takes place, we have to assume that there's going to be substantial rent growth, as Sam was saying. So I think that if that does happen, our rental rates should be increasing at a higher than historical average.
Interesting. One of our very, very large multi-market clients and I were having this discussion. In your scenario, Bill, that's more of a disruptive scenario where things aren't moving in concert and gradually and in a measured pace.
Yeah, it happens.
All of a sudden, the Fed had to step in to fight inflation. All of a sudden, the wheels catch more so than we expect, and so on. And so that probably spells a temporary disruption. There might be 2 or 3 quarters where all of a sudden valuations and cap rates and so on, buyer-seller expectations get out of balance. But the comment this client made was that if I'm a 10, 15-year holder, if I'm at least a 5 to 7 year lock on my current interest rate, and what we're talking about plays out, it can't be a fundamental crack in the foundation of the marketplace. It's more of a adjustment period, more of a temporary disruption. So even that kind of disorderly unfolding of events, I don't think is going to necessarily put us back into a crisis mode.
Well, and I think the Fed over the last few years, has really shown its colors. It's been very open. It's forecast. It's let us know what's going to happen. I don't think they're going to take overnight moves to stop stimulus. As I said earlier, I think they're going to start pulling it back little by little to allow the market to adjust to it. And yes, we will see interest rates push out, but I don't think we're going to see the big pushes. I was just describing that if everything happened at one point in time, it would create a bit of a disruptive market for things to be able to catch up, and that's traditionally what's happened.
We had the audience responses up on the screen. It looked like there was a very big mix in terms of expectations for valuations. John, a lot of audience members also asked about the value add part of the equation. It seems with Class A prices being what they are, the yields that you showed on your graphs, it seems value add going into a B, a B minus, maybe even a C, and then doing the upgrades is a way to go. But the audience wants to know from you if that's really a viable strategy. You're seeing more and more of it. And they want to know from you, Bill, if they can finance it.
Right. Do you want to go ahead and do that?
No, go ahead.
Okay.
I'm going to take some notes while you're asking.
Okay. The answer is it is a viable strategy. It's a viable approach for a value add. If an investor finds a property that can be repositioned, we're seeing more investors that are chasing that. Now, it's not as if it was several years ago where you find the deal that has very high vacancy and is very easy to go in and do some kitchens and baths and dramatically increase your rents. Those deals have just been picked over, not nearly as much. What we're seeing, which is very interesting, is the 80s construction, and which historically has been investors have bought, held on to, not done a whole lot of changes to. But a lot of the secondary markets, the tertiary markets, the 80s construction product, investors are starting to push into those and saying, I can improve the quality of this. I'm going to be able to stay just under a new construction product, but I'm going to be able to demand much higher rents than my competitors. So I think that's where a lot of the opportunity is. I think that's something that we're going to see more and more people go after. The question is, and I think, Hassam, you started to touch on this, if we have investors that are chasing deals in secondary and tertiary markets, and we continue to have some of that cap rate compression, are they going to be able to get those deals financed?
Well, clearly it's a bit of a tale of two cities right now. The larger Class A, Class B deals where the investors are trying to take those to under Class A but kind of move them up and create value. There's plenty of money available there. It's well served by private and public debt funds, even commercial banks. When you get into the smaller transactions and you're in tertiary smaller markets, it does become more disjointed. It is harder to find that capital, but lenders will get there. I suspect that there are a number of commercial banks that would take that risk on, would rather do that than a pure startup construction deal for them because there's less risk. It's all, they know what the market is. But I think sponsorship is going to be key to those transactions. Certainly the ability to demonstrate that you've done it before and you can do it again. Markets that demonstrate the rents are actually there and you're just trying to catch up with rents and you can do that. Clearly it is available today.
Good. Well, it's interesting. The audience feels best about stable Class B, where you don't have to do much. There's no risk factor, 34%. 32% said they would prefer to do light value add. And that's a very important point because in the early 2000s, when value add really had its last big cycle, we saw so many investors overshoot. Right. You over-improve the property. You expect really high rents for the trade area or the submarket that just does not pan out. Right. And a lot of those investments did not work. So to the degree that it's a light value add and very measured, the audience agrees 32%. Only 22% of the audience felt it's a good time for a full-scale renovation,
I don't know that I disagree with that. Yeah. I mean, I think that when I'm looking at the 80s construction, for example, was the example that I used. That's not a deal that you're going in and doing an enormous rehab on that property. That's somebody going in and analyzing what is my cost for new kitchens, new bath, new light fixtures, maybe an updated package on my landscaping, but that's going to fall under a little bit more of a light upgrade. Reposition it in the marketplace, allow yourself to be more competitive with some of the newer product, and I would completely agree with that.
Sure, that makes sense. We have a lot more questions that there is time to respond to. We will address your questions via email. And John, I'll turn it over to you for closing comments.
Thank you very much. I want to thank everybody for tuning in today. I want to thank Hussam Naji and Bill Hughes for joining me on this webcast. And thanks for joining.